All right, good morning or good afternoon, depending on where you're dialing in from. Welcome to Multnomah Group's April webinar. Today's topic is sort of a refresh of the environmental, social, and government investments. There's been a fair amount of activity relative to sort of the nature of the use of ESG factors, especially as it relates to retirement plans. My name is Greg Johnson. I'm a senior consultant here at Multnomah Group. I'm joined by new principal to Multnomah Group, David Williams, who's also the head of our investment committee. Just as a quick reminder for some of you that might not be as familiar with Multnomah Group, we are a full service retirement plan consulting group. We have 161 clients sponsoring 258 plans. We have over $25 billion in assets under advisements and 9 consultants in several states, primarily in the West. So I mentioned that there's been a fair amount of activity. ESG investing continues to be a very hot topic, especially politically, and we'll talk about that a little bit. But before we get into that, I thought it was worthwhile to take some time just to revisit the whole concept of ESG, sort of the history of it a little bit. We'll talk a little bit, David, primarily about sort of what is ESG investing, what are the components of it, and how has that category evolved really over the 10 to 15 years? It's really changed a lot in sort of how factors are taken into consideration, and David will have a few points on that. Talk a little bit about where most of the interest is coming from for ESG investing. We'll talk about how Multnomah Group selects and monitors ESG funds. There have been quite a few new ESG products hitting the market lately. Many of them don't necessarily have a long track record, but there's definitely been an increase in investment companies offering these types of investments, and they're doing it in response to what they see as participant interests. Finally, I'll sort of close with sort of what's going on with some of the DOL rule on the political activity relative to that. There's been quite a bit of activity with a DOL rule passing at the end of last year, and the response to that has been fairly swift. So we'll go over all that. So with that, I'd like to turn it over to David to just sort of talk about at a high level the components of ESG, and then also sort of talk about how it's evolved over time.
Great. Thanks, Greg. Just a quick reminder for folks, we do have the chat feature and question and answer feature open in Zoom. If you have thoughts or questions, feel free to post those there. We'll attempt to address them during the discussion. If we're not able to, we will certainly follow up with you after the fact. So maybe just a quick overview of the E, S, and G components of environmental, social, and governance investing. Really new nomenclature for a process that's been in place for probably the last 20 to 25 years. It's an attempt by asset owners and investment managers to link financial performance to these 3 criteria and determine if financial performance is positively or negatively influenced by how a company addresses these 3 factors. So we'll start with the E, E being for environmental, is really an attempt to assess a company's interactions with the physical environment. So it's seeking to link stewardship of the environment with company financial performance and ultimately to shareholder value. We certainly have, every company is utilizing natural resources and really trying to determine the effect of those on those operations on the environment. And then, I think the last one is where we see most focus, at least as of late, with, as the environment changes, as we see a depletion of resources, how will that impact managers and shareholders? Certainly if and as we see a changing environment and depletion of resources, there will be an impact on companies' business models and resulting performance. All all companies will be impacted and are impacted by the physical environment. I think one of the common things that we see discussed is oil depletion. I think there's certainly a focus on, as that, I guess, resource that is not regenerating, as that depletes over time. Certainly there's an impact on energy producers, oil extractors, and they will have to shift how they generate their revenue and deliver value to shareholders. But it certainly goes beyond that. All companies interact with the physical environment, and as oil depletes and energy prices rise, what will those high energy costs do to different firms? And each firm interacts or has a greater is more impacted by higher energy costs. So Greg and I have talked about specific examples. If you maybe roll back to consulting firms, as higher energy costs exist, what will be the impact on the business results of a consulting firm? Will it change its practices to use more technology solutions to deliver information, and maybe switch away from in-person in-person meetings that result in higher costs to the company and lower value delivered to shareholders? We switch over to the social. I think the social one is it's potentially the most difficult to quantify, but social factors, impacting both long-term and short-term company performance, primarily thinking about it through consumer preferences, but also workforce. And if you think about it from the workforce, up front, if a company is focused on the needs of their employees, the preferences of their employees from a work-life balance standpoint, from a safety standpoint, a company that's focused on those with an eye towards the employee, the likelihood is it leads to lower turnover, higher productivity, and ultimately higher returns to shareholders. You can look at this from a community engagement. Are they, good partners with their community? Does that engender goodwill with ultimate customers that creates brand loyalty and the ability to maybe charge a higher rate for the services that ultimately delivers value to asset owners? So there's certainly supply chain management issues. You can see companies that are hurt by not necessarily the product that they're delivering, but how that product is ultimately manufactured, transported, and delivered to end consumers. And if there are issues up the supply chain, it may cause customers to ultimately be a little less likely to purchase their product, and ultimately less loyal, which drives down profitability. Again, this one tends to be a little harder to tie directly to company performance, because there's usually not a specific event, although we could certainly go back and look at supply chain issues over the last couple of years, or in the past around look at manufacturing issues with, say, Nike or Apple, and how those products are manufactured, and potential issues that caused with consumer loyalty, and ultimately some pricing pressure and loss of value. On the G side, so the governance side, the idea is that good corporate governance is expected to mitigate risk associated with mismanagement and regulatory scrutiny, which is a mouthful, but essentially the governance aspect, the G of the ESG is looking to make an assessment of a company's management and their willingness, ability to avoid unnecessary risk-taking that has outsized impact on shareholders. And I think we can certainly look at past history and see that there are, the G tends to be a little bit more of a black swan event, maybe it's the wrong term, but they do come around. They come around more often, and when they do come around, there's certainly some outsized down effects on the downside. So common things that asset managers and asset owners are looking at here is, board construction. Is the board truly independent? Does the board have the ability to influence the direction of management, or is it a mouthpiece for what management ultimately wants to do? Looking at established codes of conduct, governing employee rules for engagement and how business is done. So this, big areas here are around making sure codes of conduct, if you're doing business internationally, are you complying with international regulations around influencing contracts? That's certainly something that comes into effect. In our business, it's around codes of conduct, around, making sure that there's conflicts don't exist in how decisions are made and recommendations are provided to clients. Executive pay is certainly one that's gotten a lot of attention. Looking at the, what are the incentives for executives? Are they short-term? Are they long-term in nature? The longer term in nature they are, the more accretive they are to value for shareholders. That's certainly something that is in the focus. Has been the focus of the general investing public over the last 10 to 15 years. Risk management we've talked a little bit about. I'll talk a little bit more in a second. Shareholder rights. Do shareholders truly have rights to influence direction of companies, or is it there's lip service paid to that? Again, it's hard to, I think, pin good governance to value creation, but you can certainly see it in times of crisis. I mean, we can go back over the last 30 years and think about things as most recently as the regional banking crisis from a risk management standpoint, high correlation of customer base. And when, there is an issue with that very narrow customer base, we've seen what that's done to some of these regional banks. You go back in history to Enron, and some of the, the management and board linkages there, and not questioning truly the direction. Volkswagen, the emissions, testing cheats that occurred back in the middle of the last decade, which led to, large fines and a loss of shareholder value. Wells Fargo, banking, trying to meet sales goals by creating fake bank accounts to make sales targets, led to a lot, change in management, as well as some outsized fees. So I think good governance, again, is hard to potentially tie to day-to-day shareholder value, but you certainly see when it's not there, you see the decline of or loss of value as a result of it. Maybe let's jump forward now that we've tried to establish what the E, S, and G are. How has this category evolved over the last, what I'll say, my working career, because I can only speak on my working career, but looking at this over the last 25 years, we've had a couple of different names for the category. I would say early on, we started off with responsible investing or socially responsible investing, SRI. There was, modest use of impact investing or economically targeted investments. But this is kind of all fallen under the category of E, S, and G over the last couple of years. If I take maybe a further step back and say, when you're making an investment decision or creating an investment strategy, you can really be one of two things. You can be a passive investment, or you can be an active investment. So if we define passive investing as, seeking to replicate a publicly available benchmark, many investment strategies will seek to replicate, say, the S&P 500's performance by buying all the companies that make up the S&P 500 in the same amount is in the index. Anything that deviates from that is taking an active risk away from that benchmark. So ES&G strategies are simply in my mind, and it may be a simplistic view, but in my mind is a departure from an index strategy. So it is an actively managed strategy looking to deviate from a broad index. And it's simply using these types of these ES&G types of factors to express a portfolio view. It's not dissimilar to, an actively managed large cap growth manager looking to buy stocks that are growing at multiples higher than the index, or a value manager looking to buy stocks that are selling at a discount relative to the benchmark. It's just simply, in my mind, again, and it's certainly one person's view, it's trying to build a portfolio that expresses the portfolio in the terms of environmental, social, and governance characteristics. So again, if we step a little bit back into history and say, how did this start? I would say late 90s, early 2000s, you started to see some managers or asset owners want to build portfolios that expressed a view by things that they didn't own. So we had screening, where we were screening out certain categories or industries. One of the first ones that I personally worked on was with an organization that wanted to avoid alcohol, gambling, and firearm stocks. And so they found a manager that was able to do that. It was through a separate account, and they just, gave them a list of securities that they didn't want to own. It's moved on. Screens have moved on from that to being more broad, not just types of industries that they didn't want to own, but certain levels of revenue coming from those types of activities. So it included things like nuclear energy or pharmaceuticals. It broadened out, and eventually there was such popularity that the asset managers created or index providers created indexes that were based on these popular screens, so that managers could use that ESG screening process that created the index to provide a product that was more broadly available to defined contribution plan sponsors through mutual funds. Responsible investing and screens kind of started around the same time from my perspective. The difference with responsible investing is not only were you looking to express a view using ESG, but you also used the power of your ownership to affect change through proxy voting. So again, this is probably the domain of large public pension plans and mutual fund managers, but largely on the pension fund side, where they would hire proxy voting advisors to vote proxies in a way that would reflect their values. So whether it was on an environmental issue, or what we saw often early was around employee kind of working environment. Or so around making sure that there were safe working environment and promoting certain values that the asset owner was looking to generate. Impact investing, probably the most uncommon in retirement plans, but there are certain aspects that we do see. Essentially here, what we're looking at is making investments with the intention of generating a measurable beneficial social environmental impact alongside investment returns. A mouthful to say, I want my assets to help further a cause that I, as the asset owner, believe in. Where I've seen this personally is, asset owners looking to affect, issues around housing, making sure affordable housing is available through building of apartment buildings, or supporting certain, green infrastructure type of projects. The other area I've seen it is with, trying to generate work. So asset owners investing in real estate that is development oriented so that it provides hours for employees that are also participants in the plan. And then finally, ES&G integration, where we see, this moving away from siloed separate strategies to being part of a typical active manager's process, not a single factor, but part of maybe a mosaic approach. So you could see that an investment analyst, trying to determine, is XYZ stock a good stock, looking at not only the financials and projected growth rates of future sales, but also how is this company interacting with the energy depletion from an environmental standpoint? How are they interacting from a supply chain management standpoint, both up and down their product line? What's the board structure? Does it provide a good balance and check for management, ultimately to bring together and determine, is that stock fairly valued? Is it got good growth prospects? So on and so forth.
So David, I think there's a couple things here. Historically, when you were just looking at those anti-sin stocks, the alcohol, tobacco, firearms, gambling, it was pretty easy to define, right? I mean, look, we're just not going to invest in these things, and that's it. If the company is heavily involved in these things, they're off the list. And I think back then, the challenge of the advisors or the investment companies was, the thought was, if you exclude these asset categories, it's going to be challenging in certain market cycles to keep up with the index. So, I think when this first arrived, the goal was really just simply to get back to meeting the index. The evolution that you've just described here really shows a change in the thought process, which suggests I'm going to add value and beat the index by investing in these companies that we believe are doing positive things for the environment, for all the things that you said earlier when you talked about the ES&G. It might not have immediate short-term impact, but these companies that are following good practices, following good governance, doing good things for the environment, ultimately will have higher returns than companies that do not do those things. And that's where I think it's gotten a little confusing, especially as it relates to retirement plans. I think when your discussion of impact investing, that's probably where some would look and say, hey, is a fiduciary potentially clouding their judgment with the impact investing component at the expense of potential return? And does that impact their fiduciary responsibility to the plan participants? And so I think that's why you see some of the pushback that we're seeing against some of these ESG factors.
No, I think that's really fair. I think at the end of the day, we'll talk a little bit about it more as we go through this, but I think the retirement plan fiduciary has that responsibility to think about this in the terms of risk and return. And that's how we, continue to have talked to clients about it for years, and we'll continue to talk to clients about it. It's not just, is ESG good or bad? It's, how does it I guess, fit in with your overall investment menu design? So maybe let's jump to the next page. We have one slide here on, where's the interest coming from? And this specifically addresses the participant side. I think there's also an alternate area where we could talk about it coming from, other external forces, whether it be particularly in the higher ed space where we work quite a bit, from students wanting to see all asset pools managed by the institution that they attend, incorporating some ESG factors and expressing ESG preferences in the retirement plan. But as it specifically relates to participants, which our client committees are trying to develop a plan that meets the needs of that diverse group, there's some statistics here that support its participants are interested in the topic. And certainly I think you have to be careful with any survey that you see, read the questions, make sure that you understand how it's being phrased, and then maybe how that ties back to actual action. But we certainly do see participants interested in ESG, certainly more so the younger the participant is. If we break it out by generations, older, baby boomers, less interested in maybe seeing ESG incorporated into default options, younger participants, much more so. The second question on here is around, trade-offs between performance and ESG principles. Which would you choose? Younger generations are, want to see ESG prioritized potentially at a higher rate over investment performance than older generations. But there's not, I don't know that there's necessarily consensus in this data, other than to say that I think in general you see kind of a meeting of the middle there, in that middle column of, about half of participants would like to see ESG considered strategically, which I think plays nicely with how we've seen committees think about the process, or think about the topic over time. Is it's not one or the other. It's about, does ESG have a role within broad investment strategies? And then I also think it's really important to, not get carried away by the kind of that first line, which says, even my generation, Generation X Gen X wants to see, ESG options available at a high rate. But there's the difference between action and interest. We do see, Greg and I collectively consult to probably 35 plans. The majority of those plans probably offer some form of ESG options to their participants. Our firm itself has 125 clients. I'd say well over half are offering an ESG option. If we saw more than 10% of assets in ESG options, again, participant-directed plans, that would be high. The vast majority of participants, when presented with the choice, tend to stick to a default option, and that's where we see the majority of assets going. So there is interest, but the interest has not yet translated to great adoption from an asset standpoint, which I think we haven't talked about it, but I think one of the primary issues is, what is a good ESG strategy to me, and how that aligns with my social values is ultimately going to be different for Greg, for anybody else on this call. And so making sure that we have something that, again, matches a collective set of values is something that is ultimately a very big challenge for committees.
Yeah, and when we see I think you're right, 10% would be on the high end. I think 5 to 7% is probably a more common usage of this. And, even of that 5 to 7%, we don't have any statistics that say how many people really understand exactly what they're getting when they invest in those. And we certainly know for a fact that even though we tend to build out a suite of ESG options that allow them to build a diversified portfolio that's exclusively ESG focused, we know that a lot of participants don't just use that suite of funds, right? They use some of the other options available. And I do think it's important, and we'll talk more about the retirement plans and fiduciary aspects, but I do think it's just important to note that given some of the activity and the interest on both sides of the aisle politically relative to ESG factors, I think choice is always going to be an important component here. And so if you have an employee base or even a plan sponsor or a board that's very interested in ESG factors, I think it's still at this particular time in where we're at with ESG investing, I think it's really important for plan sponsors to remember that not everyone maybe wants to follow ESG principles. And if you're going to add ESG options, I believe it's really important to have similarly situated options that maybe don't have the ESG moniker on them to be available to people as well. So, choice in this area is still really important.
Let's take a look at, on the next slide, kind of how Multnomah Group, from a selection and monitoring process, is attempting to help committees in the review and offering of these products. So I'm not intending you to read the stuff on the right-hand side, but the stuff on the right-hand side is cribbed from our investment policy statement, which, the thing that we start with is that there's no distinction from a selection and monitoring standpoint for ESG options. We're attempting to hold the ESG fund to the same criteria that we hold other actively managed products. So when we're looking at, recommending a product to a client, there are minimum qualifications that we are using for active products as well as ESG products that are offered to clients. So things like, making sure there's a minimum amount of assets, there's a minimum history of the investment team that's running the strategy. There's appropriate diversification levels. There's a track record, a verifiable track record that exists. And I think that's one of the things that we've run into, particularly in the last couple of years with, the Biden administration coming in, reversing some of the Trump administration rules. There's been a growth in products, and so but we believe that there's good reason to be cautious in looking at a strategy's history to determine, is it a verifiable track record that we have confidence in the repeatability of that process going forward. From a monitoring standpoint, there's again both quantitative review by our internal team done on a quarterly basis, as well as meeting with managers that we cover to document and provide information to you, our clients, on how are these managers defining, implementing, and monitoring their own strategies, and how the E, S, and G plays into that. What we typically see offered to plan participants is ESG offerings that cover that gamut of the primary asset classes of stocks, both U.S. and non-U.S. and U.S. bonds. As Greg mentioned earlier, I think it's really important from a committee standpoint, when you're developing an investment menu, that you're offering, one of your key things here is to offer participants choice of high risk, low risk assets, of concentrated strategies and non-concentrated strategies. If you're offering ESG options that are investing in similar asset classes to what is available through more traditional management techniques, then I think you're giving participants choice, and they can express their views through their selection. One of the, I think, critical things that we are again starting to see is more managers bring in the ESG components into their traditional active strategies. And so you are starting to see more of that information flow back to committees through our investment report, where we're documenting how an investment manager is incorporating those processes.
So do we want to move to sort of what's happening in the political landscape relative to ESG?
We saved the most fun topic for the last, Greg.
Yeah. So let's see. So before we talk about, the Department of Labor rules are very specific to retirement plans, but maybe we'll talk a little bit about just what's happening outside of retirement plans relative to ESG. I think, we're seeing some states and some governors taking specific actions relative to state funds. So restricting state administrative agencies. This certainly impacts state pension plans, restricting them from taking ESG factors into consideration and actually asking them to divest from any investment company that they see taking those factors into consideration. Most notably, I think some of these actions have resulted in over $4 billion being divested from BlackRock through state pension plans. And attorney generals are also getting into the game big time. There's a variety of states doing their own separate investigations. There's an investigation with Morningstar that's focusing on their Sustainalytics and ESG rating service, trying to understand how they are rating things. There are questions being made of BlackRock's proactive actions in this space, and other AGs where they're not formally being restricted. There's still attorney generals going to the state pensions and requesting information on how ESG factors are used, if at all, in investment decisions. So all that is really happening outside of the retirement industry, but it certainly is an indicator of the strong political interest in ESG issues. So where are we at with the Department of Labor as it relates to ESG rules? David mentioned, Trump administration, Biden administration rules. Definitely, whoever's in the Oval Office does impact the agencies, the federal agencies that are making rules and decisions relative to all kinds of things, and the DOL is certainly subject to that as well. So back in 2020, actually 1 week prior to the election, under the Trump administration, the DOL announced a final rule relative to ESG investing. And it didn't really specifically mention ESG investing, but everyone knew what it was. And basically what this said was fiduciaries could only consider pecuniary factors in making investment decisions. And any other factor that you would take into consideration would no longer be allowed. It did restrict the use of ESG funds as a default investment option. So had this rule been enforced, it really never was, but had it been enforced, any plan sponsor that wanted to sort of create a qualified default investment option that it was loaded up with a bunch of ESG funds, that would not have been allowed under this rule. Shortly after the Biden administration took over, the DOL announced that it would not be enforcing the rule, that it would be reviewing the rule and making proposed changes. And a proposed new rule was released in 2021, and then the final rule came out in November of 2022. So the Biden administration rule, it started out with the fundamental premise that, and actually David mentioned this earlier, investment decisions must be based on risk-return analysis. And I think this was just an attempt to ensure that the basic components of ERISA and fiduciary oversight are still included. So ultimately, the starting point for this is a risk return analysis of any investment that you're going to offer in the plan. That is fundamental to fiduciary oversight and fiduciary responsibility relative to the investments that you offer in the plan. However, it does allow for consideration of ESG or ESG factors for investment decisions. So it is saying that you do have to start with the risk return analysis. Is this a good investment product to include in the retirement plan? Assuming it is, you can take into consideration ESG factors for the investment decisions. Now, I think it's really important to note that the Biden rule says that these factors may be considered. There was, in the proposed rule from 2021, I think there was one sentence in particular that a lot of people sort of grabbed onto, and it seemed to suggest that, and there was a lot written about it, that the new DOL rule was going to require ESG factors to be taken into consideration. It made for some good articles at the time. I did not really expect that to be the case. And in fact, I don't even think that's what the DOL really meant when they put this out. Ultimately, that would just simply, especially in today's political environment, that would simply be a bridge too far to mandate ESG factors be taken into consideration. So really no surprise that this is a may take these things into consideration. It also sort of did away with this QDIA aspect, and instead the same consideration that you use for selecting individual investments can also be applied to your QDIA. So if you did want to build out a QDIA default option using ESG considerations, you could do so. It also added this tiebreaker standard, which says that if you're looking at relatively two equal funds and trying to make a decision, you can consider collateral benefits, of course, such as ESG factors, ESG focus, when making your decision in selecting one fund over another. The final item that was included was consideration of participants' non-financial preferences when selecting investments. I do consider this one a little unusual. I think it is good to take into consideration what your participants will use, what your participants will understand. So, participant feedback is definitely something a committee should take some consideration of in building, but ultimately, I don't know that it should be the lead, it shouldn't be the lead consideration in building your investment lineup. So to the extent that this is sort of opening the door to saying, my people want these, and even though it's non-financial preferences that we're looking at, they want this type of investment in the fund, so that's what we're going to put in there. I don't think that should ever overshadow any of those other things, which is the risk return analysis. Is it a quality investment? At the end of the day, if you're a fiduciary committee member, you are making decisions in the best interest, what is best for your participants. And if the things that they are requesting are not necessarily in their best interest, it's your responsibility to know and understand that. So that was at the end of 2022. The rule is passed, and here we are in April, and there's already been several challenges to this rule. There was a resolution that passed both the House and Senate rather quickly that sought to overturn the DOL rule. In the House, it passed strictly on party lines. In the Senate, the vote was 50-46, 2 Democrats. Joe Manchin from West Virginia was joined by Senator John Tester of Montana to get to 50 for that vote. Both of those individuals are running for re-election in fairly conservative states. I think them joining and signing on to this bill, though, was pretty safe because President Biden had already made it very clear that this would be his first veto since in office, and he did ultimately veto that resolution, striking it down, keeping the DOL rule in place. There's also a fair amount of legal activity relative to this. Republican attorney generals from 25 states have sued the Department of Labor in an attempt to block the rule. Here's one of the quotes: that this prioritizes woke ESG investing over protecting the retirement savings of approximately 2/3 of the US population. The DOL has tried to fight back a little bit. They filed a motion for a change of venue. Their challenge was that the district where this was filed in Texas only has one federal judge. And so the argument is that these Republican attorney generals were basically shopping for a judge that has been pretty comfortable overturning some other Democratic positions. Similar lawsuit has also been filed in Wisconsin. So, here we are in this environment where you've got the DOL making a rule, and within the first 4 to 5 months since that rule, there's quite a bit of activity focused against trying to overturn that rule. I find it is interesting because, like I said, the rule only says that you can take this into consideration. It's not mandating that anyone do anything, yet the pushback on it has still been pretty fast and pretty furious. So this is definitely a hot topic. I do, as a plan sponsor, though, I think you're left wondering, well, what does all this mean to me? Either I have ESG funds in my lineup already, or maybe it's something that, for whatever reason, I've been considering adding some. I always go back to the same thing, and I think David will probably agree. I'll let him make some comments, but ultimately, you want to have an investment policy statement that dictates how you select, monitor, and add or remove funds from your plan. as you think about building out an ESG suite, I think the most important thing is that you continue to follow the requirements set forth in your investment policy statement as you make those decisions. Also, I think it's critical to remember that anything you do, the further you go down this road in ESG, if you really want to dive in, it is very possible that 2 years from now, you could see all of this change and required to make additional changes to your plan if you have to walk some of these things back. So I would always be mindful that the political winds could shift and it could significantly change sort of the landscape relative to ESG investing in a retirement plan.
Yeah, Greg, I mean, I'll just jump in with, a specific case or specific example would be, QDIA or your default investment. I think, we've had lots of debate as to whether or not, specific ESG funds should be offered as default. Obviously, it was, again, this pendulum swinging back and forth. That's become the most prevalent investment option or most prominent investment option in retirement plans. It's where, most of the assets are flowing towards, and whether you're looking at a plan that's went through a full re-enrollment a couple of years ago and now it's 75% of assets in the target date funds, or just a natural progression over the next 10 years, you're going to see target date funds capture 50+% of assets. Given, I think, what you've described pretty well as a pretty hot potato item, there will be, if there is a change in administration, you could see some pushback on ESG that way. And with QDIA or target date funds serving as a default investment option, I think it's pretty clear from our perspective that to offer a pure ESG product there is something that a committee would want to think long and hard about, because unwinding that could be challenging. It's not to say that you can't do it, but I think it's one of those things that's important to go into it with eyes wide open about the not only the political risk, but also the risk to participants of having to potentially make that change a couple of years after implementing a specific ESG strategy within that particular narrow default option.
Yeah, and I think given what we're seeing here, as I mentioned earlier, I think it's still important to be sure and offer choice. So not just have a pure ESG lineup, offer people other options, and always make sure you continue to monitor those ESG investments with the exact same process that you monitor any other investment in your plan, and that you're not making concessions to those investments at the expense of returns or investment performance. That's really the key to all of this.
Yeah, I mean, again, I think it's similar to, you don't offer just a purely passive management lineup and a purely actively managed lineup. The role of the committee is to, allow participants to express their individual investment philosophy through the plan, and doing it in such a way that it doesn't overwhelm them from a choice standpoint, so that they can analyze the information available to them and make appropriate decisions and be appropriately diversified for themselves.
All right. Well, I want to thank everyone for joining us today. We'll continue to keep you updated as things progress. I don't think there's any question that some of these attorney general investigations are going to turn into lawsuits. We'll continue to monitor some of the other activity that's out there, and any legislative activity. It has certainly been a hot topic with a lot of activity over the last 4 months. But I do want to thank you for your time, and we do not see any questions at this time. No questions at this time. So I think we will go ahead and end the webinar. Thank you.